All right, let's dive right into today's explainer. We are unpacking one of the absolute most aggressive market disruptors taking on legacy finance right now, the buy now, pay later industry. Honestly, it's a fascinating narrative. It is the story of how an ambitious startup idea went head-to-head with giant entrenched banks, found a brilliant loophole for explosive growth, and is now staring down regulators and the harsh realities of credit defaults. If you want to understand the future of consumer spending, you've got to understand how these companies are directly challenging the traditional credit card model.
So, picture this. You're ordering dinner on DoorDash. Your burrito bowl comes to, say, $41. But right there at checkout, you're presented with a completely different reality. Instead of dropping $41 today, you can finance that burrito with 4 payments of exactly $10.40 over the course of 6 weeks. Suddenly, that premium dinner feels a whole lot lighter on your wallet today. And by clicking that button, you are actively participating in a massive financial shift.
That little checkout trick is the beating heart of Buy Now, Pay Later, or BNPL. This modern version of the zero-interest installment loan was actually popularized back in 2014. Afterpay co-founder Nick Molnar launched it just to entice customers at his Australian jewelry store. But since then, players like Klarna, Afterpay, and Affirm have absolutely exploded. They've evolved from niche e-commerce tools into massive, everyday alternatives to traditional credit.
Here is our roadmap for today. We're going to cover the disruption thesis, unit economics and revenue, market expansion strategy, assessing consumer credit risk, and finally, the regulatory and reporting outlook. Because to really understand this disruptor's viability, we have to look at the whole picture. Okay, Section 1, the disruption thesis, taking on the incumbents. We are looking directly at the aggressive, highly confident posture of the buy now, pay later industry as it squares up against legacy banks. Just listen to this bold quote from the industry. We really believe the credit card industry is going the way of the VHS tape. I mean, wow. Talk about planting your flag, right? That perfectly sets the stage for the narrative we're exploring. These companies don't just want to be an alternative payment method. They are aiming for total market disruption. They view revolving credit and traditional interest models as legacy tech that is fundamentally outdated.
Moving on to Section 2, unit economics and revenue. How free makes billions. So, how exactly does a quote-unquote free product generate billions of dollars? Let's break down the transaction mechanics.
Here is the mechanical cycle of a standard pay-in-4 transaction. Step 1, the customer chooses the BNPL option at checkout. Step 2, the provider's algorithm instantly approves the loan, pays the retailer the very next day, and, this is critical, takes on 100% of the non-payment risk. Step 3, the customer repays the BNPL provider in 4 installments with absolutely zero interest. On the surface, it looks like the consumer gets a totally free short-term loan. So you gotta ask, who is actually paying for this?
Well, here is the ultimate plot twist in their unit economics. A massive 90% of their revenue comes from merchant fees, which can run up to 5% per transaction. Only about 10% comes from consumer fees like late penalties. The secret to the zero-interest loan is that the merchant is the one footing the bill, and retailers gladly hand over that steep 5% fee because offering BNPL drastically increases their checkout conversion rates and their average order values. It's a win-win for them.
All right, Section 3, market expansion strategy, multiplying volume. Now that we know how they make money, let's look at the growth catalysts driving this industry out of its original e-commerce sandbox and into completely uncharted territory.
The macro trend here is just undeniable. Transaction volume has multiplied an astonishing 20 times since 2019. 20x! This is definitely not just some pandemic-era fad. Consumers are actively demanding alternative ways to pay, and the providers are racing to capture every single transaction they possibly can.
And you might be wondering, where is all that new volume actually coming from? The grocery aisle. According to LendingTree's survey data, in 2024, 14% of consumers used BNPL for groceries. Today, that number has surged to 25%. This is a massive behavioral shift. It started as a way to buy a $150 pair of sneakers online, but now it's being used to finance everyday consumables like eggs and milk.
To keep this volume skyrocketing, these companies are aggressively expanding their footprint. Affirm is now offering longer-term loans, and remarkably, 80% of their business today actually carries interest. Afterpay introduced a pay monthly option with simple interest for larger tickets, where that standard pay-in-4 model doesn't really work.
Meanwhile, Klarna struck a huge exclusive deal with Walmart's fintech arm, OnePay, locking in a direct relationship with a retail giant. But the ultimate Trojan horse here is physical cards. Providers now let you pre-approve a loan on your phone, say $500 for a new jacket, and then you just tap a physical card at an in-store terminal. Industry leaders expect this move into brick and mortar to literally double their total addressable market.
Which brings us to Section 4, Assessing Consumer Credit Risk, the bear case. Because every disruption story has a looming threat, and for BNPL, it all comes down to credit risks and defaults as they acquire a much broader, potentially riskier customer base.
We are seeing some seriously conflicting narratives in the data right now. Back in January, a Consumer Financial Protection Bureau study found that more than 2/3 of BNPL loans went to borrowers with lower credit scores. Conversely, Afterpay claims their service actually over-indexes in middle and upper income brackets, arguing their consumers are highly creditworthy. But then, you look at LendingTree's data, which shows that 41% of BNPL users paid late in the past year, up from 34% the year before. The data is clearly showing increased consumer stress, which definitely contradicts the purely optimistic view coming from the providers themselves.
So how are the top providers handling this rising stress? With completely divergent strategies. Klarna reported a 17% increase in consumer credit losses in Q1 of 2025. Now, they claim this is just naturally due to higher loan volumes, and they did note that Q2 saw record on-time payments. Afterpay takes a super strict operational approach. They instantly disable an account the very second a single payment is late. Meanwhile, Affirm is actually reporting decreasing customer defaults. Their strategy? They rely on intense point-of-sale underwriting for every single transaction, making a fresh, honest assessment right at checkout, rather than just handing out a blanket line of credit.
Finally, Section 5, Regulatory and Reporting Outlook, Headwinds and Tailwinds. As this industry scales up, it's colliding hard with legacy credit systems and government oversight, creating a really rapidly shifting landscape.
The timeline of government oversight here has been pure regulatory whiplash. In 2024, the CFPB issued an interpretive rule designed to subject BNPL providers to the exact same regulations as traditional credit cards. But the political environment shifted rapidly. In 2025, under President Trump and the Department of Government Efficiency, or DOGE, the capabilities of the Consumer Protection Agency were scaled back, and enforcement of that strict BNPL rule was deprioritized. And then, looking ahead to June 2026, FICO announced it will actually begin adding BNPL loans to standard credit reports.
In that push by FICO, it's caused a massive internal divide within the industry on how to handle data sharing. Affirm has leaned right in, becoming the first major provider to openly share consumer data with bureaus like TransUnion. On the other hand, Klarna and Block, which owns Afterpay, are actively withholding customer data. They argue that legacy credit reporting frameworks simply do not fit the modern BNPL model. They're demanding a completely separate regulatory framework so their consumers aren't unfairly penalized by algorithms built for the VHS era of credit.
But honestly, despite all the regulatory hurdles and the rising risks of consumer defaults, the ambition of this industry remains absolute. As one executive bluntly put it, nothing would make our team happier than if we could see the death of revolving credit in the United States.
Which leaves us with this final massive question as we wrap up today's explainer. As buy now, pay later companies introduce physical cards, charge interest on longer terms, and begin integrating with FICO credit scores, will they truly dethrone the credit card, or will they, ultimately, just become one? Thanks so much for joining me to unpack the mechanics behind the hype. Keep your eyes on those checkout screens, and as always, keep asking the right questions.